المرة اللي فاتت حكينا بالmeasuring return. Okay? وحكينا measuring return, we can measure return by using the average return. Today I'm going to talk about how we measure risk, and we will go back to the measuring return to estimate measuring return by using the arithmetic methods and using geometric methods. هنستخدم طريقتين الارithmetic وهنستخدم الجيومتريك. Okay? First of all, what it means risk. What it means risk. Okay? What it means risk. شو معنى الريسك؟ Yes.
It's when we don't know what's going on. When we extend something, there's a risk for this exception.
Okay. Yes. Well, again, well.
Result higher profit.
Result higher profit. No.
Probability to lose our money.
The probability to lose. Why you are saying to lose?
To lose
No. Or to get. Or to yes. What is the risk? Okay. The risk is the uncertainty. Uncertainty. You are uncertain to get the cash flow in the future. So this is the risk. For instance, tomorrow, you don't know what is your cash flow tomorrow. So you are in today, and tomorrow you don't know. The day after tomorrow, you don't know. You may get cash flow by the 50% probability or 50% probability. You may receive $100 tomorrow, or you may receive $0 tomorrow. So what is the expected cash flow for tomorrow is 50% times 100, 50% times 0. So this is our expectations, and then 50 plus 0 is 50. So again, the risk is you are uncertain to receive a particular cash flow streams. If we go back to the stock price, if we are in here, today is the first day of our investments, which is 20 of November, and it's tomorrow, and the day after tomorrow, and so on. Now, the price is $15. What about tomorrow? Tomorrow could be the price here, could be here, could be here. We don't know. So, because tomorrow is uncertain. Okay, talk about the next day, the price could be here, could be here, could be somewhere. In the third day, so this is, the price is fluctuated because we don't know exactly what is going on for tomorrow. Okay? How we calculate then the risk? We calculate the risk based on the variance and the standard deviation. This is for your level now. But in the future, or in the upper level, you can use different measures, such as the values at risk. But we don't know, we don't need to talk about values at risk and other measures of risk. Because in this level, we only focus on the variance and the standard deviation of risk. So what it means variance, or what it means the standard deviation. Let's go back to our example. If we observe the price of a particular shares, let's see, for instance, this is here, and so this price is fluctuated. Started from this point to this point, and so on. So first of all, as you observe in this chart, the chart is fluctuated. So the risk is measuring to what extent the prices or the prices are fluctuated. If we have different stock, so this is stock A, if we have stock B, and this is a stock B, if we compare between stock A and stock B, what we observe?
It's fluctuating more.
Yeah, A is highly fluctuated than B, so the variance of A is greater than the variance of B. Okay? Again, because of the uncertainty, when people are uncertain, so the prices are more fluctuated. If people certain, it means if we are 100%, we will get $100 tomorrow, so it means there is no risk. So the risk is zero. If we get a stock like this, like treasury bills, so in this case, we expect tomorrow exactly we will receive $100. So this today, tomorrow, the day after tomorrow, so we have same cash flow. But in this black one, if we want to expect tomorrow, this is tomorrow. The day after tomorrow, this one. So the prices are fluctuated. The more the prices are fluctuated, the higher the variance or the standard deviation, or the higher the risk. Okay? So how we measure these fluctuations? As I said, we measure it by sigma, or the standard deviation, and then we can measure it, sigma is by the root of var. So we can use sigma, or you can use the variance. Okay? How we can do it? Let's take example to see how it works. Okay? Take this example here. So this is the state of the word. 1, 2, 3, 4, 5. The rate of return is minus 10. The chance of probability is 0.10%. And the third one is 0.5. The probability is 20. The probability here is 40 and 20 and 10. If you sum this, you will have 100%. 10, 20, 30, 40, 70, 20, 90, 10, 100. So the sum of the probability is 100%, or 1. And this is the this is the rate of return. What it means? It means I will get minus 10% with the probability 10%. I will get 5% and the probability 20%, and so on. So how we can answer this? You should apply this, how we calculate sigma. So sigma is equal the root of xi or ri minus the expected of ri times the probability. This is the easiest formulas to calculate sigma. So, first of all, what should you do? We have to calculate the expected RI. How we can do it? Just B times C. B times C, B times C, and you will get this. Okay? Minus 10 times 0.10. 0.5 times 0.20. 0.15 times 0.40. 0.25 times 0.20. 0.40 times 0.10. And then we will get the expected rate of return. Okay? So the expected rate of return is 0.15. From the chart point of view, if you look at the chart, what exactly mean, I'm trying to connect you between the mathematical things and the chart. If this is the fluctuation, so the E of R is this. You see, this is E of R, the expected rate of return. So what I'm going to do is just this point minus this point minus this point minus this point to calculate the variance or the standard deviation. Okay, so the next step is to calculate Ri minus the expectation of Ri. So just to remind you, start by this. This is the first, then this is the second, then this is the third. You see? Very simple. Okay, so the second one, the rate of return minus the expected rate of return. So minus 10, don't forget this is raised to the power 2. Minus 10 minus the expected rate of return is 0.15 raised to the power 2. The second one, 0.05 minus 0.15 raised to the power 2. The third one, so on. After you finish this, just time this by pi, by the probability, which is in this case is 0.10. And the second is 0.20. And the third is 0.40. And finish. Just sum this. I will do this in Excel to see how it works in Excel. Okay? Yes. Okay, so in the case 1, 2, 3,
5.
we have 4. We have 4, 4, 2, 4. Oh, sorry, 4. 1, 3, 4, 4. So don't have this. Okay, and minus 10. Okay, the second
5.
0.05. The third
لا 0.05
0.05.
0.15.
0.15. Huh?
صح صح بس فوق ده 0.40.
0.40. Okay, then
The second 0.1.
the first one
0.1.
0.1.
Then 0.2.
0.2.
0.4.
0.4.
0.2.
2.
0.1.
0.1. Okay, just double check. This is 1 or 100%. This is 1, just for double check. So what you can do first, if you see this is A and this is B, so then this is C. So the first of all, just this one times B times A. Okay, just in one click you have this. Okay, now what is the total or the average is
لا 0.15.
is sorry is 0.15. So this is the expected rate of return. So we can write this expected rate of return. Expected rate of return. Okay. Now, what is the third step?
بدي أطرح
rate of return minus expected rate of return.
Okay. This one,
ناقص A.
sorry, is equal this is the RI minus the expected RI raised to the power, okay, minus this one, this one, minus the expected rate of return, okay, don't forget, raised to the power 2, where is the power? Raised to the power 2. Okay? And don't forget this is fixed. Okay? And then we multiply this by the probability. This time the probability. Then the summation of this. Okay? So this is the answer. And if you want to put the under root, you will get it. But we can do it in one click. Okay? Yeah, I want you. So this looks like the for the yesterday exam, and I ask you to calculate the arithmetic, geometric variance, which is what I'm saying today. This is the variance. Okay, let's start by the variance. First of all, we will calculate the daily return.
Yes.
Okay, so the daily return, you have your data. Use the stopwatch, please, to see how long it takes. So this is the min, this is the max, this is first quartile, and what else? That's it. Average, geometric, variance, min, max, first quartile. Okay, let's use now the stopwatch. Mean, okay. So mood and median. Okay, so this is the question. This is yesterday the first question, like this. Now we want to calculate. The students have this.
Yes.
And what they want to do, just to use the calculations. They don't need even to type anything. Okay? Start the stopwatch now?
Yes.
Okay. So we want to, first of all, we want to calculate the daily return. It's equal B1 minus B naught minus B naught. Okay? And just do this. Now we want to calculate the average or the arithmetic. This is the arithmetic. You can take this. And we finish. Okay? Now the second, the variance. Sorry, here. The variance, leave the geometric for a while. Use the variance, which is, I'm talking about the sigma or the standard deviation. The risk, which is equal var, okay? And that's it. If you want to calculate the standard deviation, you can add the standard deviation, very simple. Okay, so standard deviation is equal standard deviation. Okay, and that's it. We want to calculate the min, so this is the min. Okay, the max, this is the max. And if you want to calculate the first quartile, this is the first quartile. Okay, this is the first quartile. Okay. Okay. If you the mood, this is the mood. Okay. The median. This is the median. The geometric. Go back to the geometric. Very simple for the geometric is equal the B1 divided by B0 to avoid the negative signs, and go back to the geometric. So it's equal geometric. Then you have this and minus 1. Okay? This is all of the questions. We calculated the arithmetic, the geometric, variance, standard deviation, min, max, all of them. How long it takes?
2 minutes.
With the student, sorry?
2 minutes. 42 seconds. Yeah.
And 44.
Yeah, with the student it takes just one and a half. Okay, 250 is fine. So they have 5 minutes. Huh? They have 5 minutes. I give them 5 minutes. Okay, anyway. So what is the idea here is how to calculate the variance. How to calculate the variance. The variance, as I said, or standard deviation, you just use an Excel, you can apply this. Let's go back to the this is the variance. Okay, for our example here, if we go back to the slides, see the variance is the same. If you want to calculate the standard deviation, just go to the roots. Okay. Okay. So this is how we calculate. Now, we will talk about the brief history of the financial markets. Any question for the standard deviation for the in your textbook? Try to train yourself in estimate the variance and the standard deviation. Okay? Try to use your calculator. In your calculator, it takes around 1 minute to estimate the sigma and to estimate the standard deviation. Just it's a matter of training. A brief of the financial markets. We can use tools that we have laid to determine the risk and return trade-off in the financial markets. Financial market is important because it reflects the risk and return. Investors have historically earned higher rates of return on riskier investments. Generally, the investors, when they seek higher risk, they ask higher return. So if we say this is risk and this is return, yes, there is positive relation between risk and return. The more risk you hold, the higher return you ask. And if we look at this here is the treasury bills. The standard deviation or sigma of this is 0. And the return is this. So there is no risk. There is no risk. If you look at, if we have here big stocks or large stock, and here small stock, sorry. If we have here small stock, and here large stock, here we have bonds, and here we have government bonds. This is ranked according to their risk. The smaller stocks holding higher risk than the larger stocks. Generally, stocks holding higher risk than the bonds. Okay, take this case. If we invest in larger stock, it means we hold 7% of risk and we take 5% return. But if we invest in smaller stock, we hold higher risk. So this risk is 9%, so we hold additional 2%. Because of this, the financial market should compensate me with, let's say, 1.5% return. So this difference known as premium. Premium. Because I hold higher risk, the market compensates me with the higher return. Okay? What I want you to understand is the security with the higher risk, or the investors holding higher risk securities seeking higher return. If the financial market fail to reflect this information, so the financial market is not efficient. We are talking about the efficient financial market. If the market is efficient, we will observe the higher risk securities offering higher return, rate of return. However, having a higher expected return simply means that investors expect to realize a higher return. Higher return is not guaranteed. Yes. Let's see the figure 7.2. What we observe in figure 7.2. Look at this. We have, as I said here, we have small stocks with this dark blue, and we have large stocks with the blue, and government with the red one, treasury bills with the green. What we observe in this chart, that the treasury bills has or suggest the lower risk. If you go up, you will see the smaller stocks suggest higher return and at the same time higher risk. Look at here. As I said, we can calculate return and we can calculate the standard deviation. The return is measure of return and the standard deviation is measure of risk. Just compare between two things. The small stocks offer 11.7%. Look at the treasury bills offer 3.7%. So the small stocks offer higher return than the treasury bills. But if you look at the risk, the small stocks holding 34% as the standard deviation, but this one is 0.9% as the standard deviation. So the smaller stocks are riskier than the treasury bills. And the same thing if you compare between large stocks and government ones, the large stocks suggesting higher return and higher risk than the government's bond. Okay? So what we understand, the riskier investments have historically realized higher rate of return. And because of the difference between the risk and return, or the risk of small stocks and larger stocks, the market, as we said, should compensate us by the premium. So it's called equity risk premium. Lesson 2. The historical returns of the higher risk investment classes have higher standard deviation. So look at the standard deviation in the bottom. The standard deviation is higher than in the small stocks than the treasury bills. And again, just the standard deviation is the measure of risk. If we rank them, let's compare the United States stocks versus other categories of investments. We will compare the United States stocks, real estate, the international stocks, commodities, and gold. What do you think? Which is holding lower risk? The stocks, gold, real estate, international stocks, commodities. What do you think? I'm asking ladies now. Which is safer for you? To invest in United States stocks, real estate, international stocks, or gold? Yes, gold. Because it's secure. Look at here. It's gold.
Yes.
Gold is gold. Yeah. So if you compare between real estate with the red one, United States stocks with the blue, and compare with the commodities, and the gold. You will observe that the gold holding lower risk, and because of this, holding lower return.
Yes.
Because it's not risky and not fluctuated too much. Look at the. But look here, the channel of this. This is the channel. But look at here, the channel is. But look at these things, high fluctuated. Okay? Now, what we can observe, that gold had the lowest rate of return comparing with other. Yes. The fluctuation in rates of return over a period of time is called the investment volatility. So, if we see here, this is volatility. The more the stocks volatile in the market, the higher risk. If you compare this one with this one, this has low volatility, so lower risk. This has higher volatility, then higher risk. So we can measure the risk by using volatility. Variation. Now, let's compare the financial market international investments. Look at we will compare the United States with other markets. With the international markets, with the European countries, and with the Pacific. If you observe, in the United States, having lower risk and lower return. But if you look at the Pacific area, it's holding or having higher risk and higher return. Then the international is next to the United States. So don't think that invest in the United States giving you higher return. Investment in the United States giving you the lower return and the lower risk. This is why the MNCs, multinational corporations, prefer to invest overseas or off the United States. They invest in Africa, they invest in some areas in the Middle East and in Asia. Why? Because in these, yes, higher return and higher risk. And they know how to control over risk. Okay? For the global financial markets, we observe that the Pacific stock had the highest volatility. Look at here. The volatility from minus 36% to the 100. So you can make 100% or over 100%, or you can lose minus 36%. But in the United States, you can just lose minus 37% and 37%. So the fluctuation is very, very close. But in here is very wide. In contrast, the United States stocks had the least volatility with returns ranging from 37 plus minus 37. Okay? So let's stop in here and we will talk next time about the global financial markets. And next time I will finish chapter 7. Okay? Trade yourself. We have 10 chapters. 3 chapters. Okay? يعطيكم العافية.